Hi there, traders. Let's get started with our fundamental series. Now, I'm going to try and keep this series probably under 5 video, and that's simply because I don't want to overburden you with too much information. And for that reason, I've put together a brief presentation so that I don't wander off and start talking about things that really shouldn't matter to you. Okay, so let's get into it. Now, in this particular video, I'm going to give you a run through what fundamentals are and what types of fundamentals exist and what you should be actually paying attention to. We're also going to have a brief look at the economy. You really do need to understand how the economy functions in order to be able to understand how fundamentals impact upon it. Now, I'm going to give you a very brief explanation in regards to the economy because, again, it's a massive subject area. But then I'm going to also give you a link to Ray Dalio's video, which is The Economic Machine. He gives you a brilliant explanation as to what the economy is, all the players within the economy, how it functions, over like a 30-minute video. And for those of you that don't know who Ray Dalio is, he is possibly the best fund manager of our time. Right, so when this guy speaks, we listen. The link to that video will be below this in the info section. And so please do watch it after you watch this video. We're going to have a look at the key economic indicators. These would specifically be the ones that you would find in the news sites that you visit, which would be investing.com, FX Street, Forex Factory, and the like. There are other economic indicators out there. We will look at some of them in following videos, but for this video, I'm going to show you only the ones that I want you to pay attention to. Okay, so next we're going to have a look at the business cycle. Now, economic indicators are extremely important, but they matter most when you have an understanding of when the news release or the data that comes from them, when they actually matter. So if you have an intimate understanding of the business cycle, you'll start to understand that certain economic indicators matter more when, say, for example, the market's in an uptrend or when the market's in decline, right? And then we're going to finish off by looking at the major key player when it comes to fundamentals for us, and how we're going to utilize the central banks to kind of cheat our way into understanding how we should be trading or which direction we should be trading in, right? So let's jump to it. Now, the first thing is, simply put, what do fundamentals show us? What do they mean to us? In short, fundamentals will give us a snapshot of the health of the economy or the state of the economy as it presently stands. So if we kind of see and understand where this is, and then you have an understanding of the business cycle, you'll be able to place your finger on the business cycle where the economy is. And so knowing that will give you some degree of insight and predictability into where the market's going and what other opportunities are coming to you in the near future. Okay? Generally speaking, for us, how do we utilize this information? Well, one, fundamentals and economic indicators will show us if the economy is strong or weak. If the economy is strong, then we would expect that the currency associated with that economy is going to be strong as well. If the economy is weak, then the currency associated with that economy is going to be weak as well. I'll give you an example. If we're seeing economic indicator releases for cable, so GBP USD, or GBP in particular, all the economic information coming out from the UK is that the UK economy is strengthening. It's becoming a lot stronger. It's heating up. What that generally tells us is that the pound should be strong as well against most other currencies. So we've got a system whereby if a currency is strong, generally speaking, interest rates will start to go up, and most investors or smart money will start pouring money into that economy or that currency simply because the central bank will probably raise interest rates that would be highly profitable for smart traders or smart money. Okay. Now, in technical analysis, the key part or the first part of our main criteria should be to determine the trend, right? Because our overall goal doesn't matter what asset class you're trading, our overall goal should be to always trade in line with the trend, right? So our technical analysis, the structures, and just by zooming out and looking at the screen from left to right will give you some indication of where the market's going, right? So higher highs and higher lows, market's trending up. Lower highs and lower lows, market's trending down. Where fundamentals kind of play a role for us is that if we understand that the economy is strong for that currency, we know this currency should be heading up in relation to other currencies that are weaker, right? And vice versa is true as well. So if we're looking at our charts and we've got a downtrend happening, right? So daily chart, 4 hourly, 1 hourly, and then 15-minute chart, we've got the market from left to right pointing downwards. We then look at our fundamentals, and where fundamentals come in handy is to give us reasons as to why, when we're looking at our technical charts, that the market's going down. So if the reasons, which is the economic indicators, correlate with what our technical analysis is showing us, then you've got 110% confirmation that your prediction is correct. So overall, when we understand the strength or weakness of an economy, it should, in essence, give us some idea of what the macro level direction of the market should be. So the macro level could run from for the next few weeks to the next quarter or possibly longer. For all intents and purposes, for us, we should be looking at the economy quarterly. Okay, because most economic indicators will come out quarterly, and some of the leading indicators will come out over like a weekly basis. We'll touch upon that in a following video, but overall, quarterly economic indicators are what we want to pay attention to, and that will give us some insight as to what the market should be doing a week in, fortnight in, or monthly in. Okay. Now, what are fundamentals? Essentially, fundamentals would be anything and everything that impacts on the economy. Because why? When it has an impact on the economy will either strengthen or weaken, right? If it strengthens, again, currency gets stronger. If it weakens, the currency gets weaker, right? That's all we really need to decipher when we're paying attention to fundamentals. Beyond here, what we pay attention to is what type of fundamentals will impact on the economy in which way, right? And so that's where kind of becoming more familiar with the types of fundamentals will help. Many of you are probably just familiar with the registered news releases on the sites like Forex Factory and FXTradeInvesting.com and the like. These are economic indicators, right? And again, they could be monthly, quarterly, weekly as such. Which ones we pay attention to, again, will be determined by where we kind of sit within the whole business cycle, and we'll get to that later. And also, these economic indicators are what the central banks pay attention to. So all the decisions that the central banks will make in regards to interest rate and the like will be based off these economic indicators. So when we're looking at them, and we'll get to them shortly, but when we're looking at them, what we're trying to decipher is the economy getting stronger or weaker? Okay. Next, statements by the central bank members. So again, when these members are looking at the key economic indicators, they're going to come out and they're going to give speeches. Why? Their role is to always kind of talk up the economy, and within that, they will be utilizing key language that gives us some indication of what their area of focus is. So, for example, if they're looking at raising interest rates and they're really talking up the economy and saying, the economy is doing really well, inflation is slightly going up, so we're going to have a bit of a look at that, or keep an eye on that. What that tells us is that, yes, the economy is heating up, it's getting stronger, and so what the central bank may consider doing is tightening or increasing interest rates, so tightening monetary policy, right? So when they say we're going to increase interest rates, or we're going to consider increasing interest rates, what that generally says to us is this currency should be on an uptrend, right? Next, policy of sovereign governments. This is quite key in that we've got to understand that um, the central governments don't actually make monetary policy. Yes, they can have their own policies that impact on the economy overall, but monetary policies largely is the domain of the central banks, right? But the sorts and types of policies that belong to the domain of the central banks that have an impact on the economy, which will then have an impact on the currencies, would be one things like the budgets, right? So um, when you have your yearly budget in whatever country you're in, what that gives us is some idea of if the government's spending too much and maintaining a deficit or a surplus within their budgets, right? It will give us some idea of if they're having to borrow on a daily basis to fund public works, right? I'll give you an example again. When Julie Gillard was Prime Minister, we were at that point in time borrowing $3 million a day to fund public works. And where we borrowed that money from, we'll get to that later on. But that's essentially giving us some idea of whether that's going to add to the strength of the economy or weaken it. The other types of policies that governments come up with some of which you guys have been familiar with recently, tariffs, which create trade wars, and so they will strengthen and weaken economies. Tariffs generally weaken economies and other economies that are connected to the nations that are kind of engaging in a trade war. And again, a negative impact on the economy will have a negative impact on the currencies. Another famous policy of governments was Brexit, where you guys would have seen that the pound and the euro absolutely tanked after the results came out. North Korean missile tests. Remember the time when North Korea was firing missiles over the top of Japan, and we saw the JPY pairs, the yen tank, um, border walls. So when Trump became president and won the election, what we saw at that point in time was the Mexican peso start to tank against the US dollar, and that was primarily because Trump had a policy of a border wall that the Mexicans would pay for. Right, so those sorts of unilateral, bilateral, multilateral agreements has to some degree a lasting impact, sometimes a short-lived impact, mind you, on the state of the economy, which will then affect the currency pairs. Give you an example of a multilateral agreement, for example, the Iran deal or NAFTA or TPP, when President Trump pulled the United States out of the Iran deal or the Iran agreement, what we found was that oil prices started to go up, and that was because, I mean, the United States don't trade directly with Iran. However, they do have significant influence. So when you're looking at their influence upon their trade partners that do trade directly with Iran, that could lead to sanctions against Iran, which and then also it's actually creating some sort of crisis. There was also the possibility that Iran may withdraw and then start putting back their nuclear facilities, producing nuclear weapons, and then as a result of that, there's going to be increased tensions, and all of that will have to some degree an impact on the economies of all those nations around them, and so again, as a result of that, have an impact on the currencies. The next one that has, and we are now heading into this, is having a look at demographics. So, a key example is having a look at the aging population. So, most Western countries around the world has a significant aging population. And what that means is that the portion of baby boomers completely outnumber any of the other generations. So, what we're going to find by, say, 2025, 2030, by far the majority of baby boomers would have entered retirement. Now, that will have a severe impact on pension requirements. It will have increased burden on the healthcare systems, in particular nations like Australia, where we have a single payer healthcare system. So the retirees will probably start to get sick more, and that they will require hospital care. And also that because they outnumber all the other generations, we're going to have fewer Australians that are gainfully employed paying tax. And so what we're going to find is that the public purse is going to start to shrink, but at the same time, the actual cost requirement for public works will start to go up. So that is a key challenge that the Australian government would have going forward into the next decade, right? So that has an impact on the economy, which will have an impact on the currency. Next, we have statements made by world organizations like the UN, IMF, World Bank. The UN and the World Bank, as much as we'd like them to shut up and do nothing, do make statements that have a clear impact on world economies and also currencies. The UN, at the same time, if there's a Security Council binding resolution that puts in place sanctions, for example, those sanctions will impact on economies around the world that trade with whoever the sanctions are being placed on. And as a result of that, we're going to see some degree of impact on the economy. The other one, geopolitical crisis. So the issues in the Middle East, Syria, for example. We're going to look at refugee issues going into Europe that is now causing a significant burden on economies in Europe, also Britain. In Australia, when we had the boat people coming over, the refugees that came via Indonesia into Australia via fishing boats. In 1 year alone, Australia spent about $17 billion on the refugee programs that we had. So you can imagine the impact that has on our economy, because that $17 billion that could have gone into public works has been pulled out to fund this. So we've got that hole there. That will increase the budget deficit that we have. So the governments will come out and generally say, you know what, we're going to have to either tighten the public purse, we're either going to have to increase taxes in some way, shape, or form to make that up, or we're going to have to increase our deficit and possibly delay until in the next few years until we come back into a surplus. And for those of you that are unaware of that, it's basically just taking a budget of government expenditure, money, cash inflow, and cash outflow, and saying that we are spending we're spending less than the amount of money we're making. Okay. The next one, environmental changes, natural disasters, and weather. So environmental changes are things like global warming, the impact that has on economy. So when we're looking at that most nations that have been guzzling oil or greenhouse gases and the like, factories, for example, are now having to change in technology to become more green, to, like, for example, solar panels requirements. That increases costs for businesses and increases costs for central governments. At the same time, we've got carbon taxes going up. So again, that actually has clear impact on the economies, because again, either the companies pay for the price of carbon or carbon emissions from their own pockets. In most cases, a smart business person wouldn't. What they do is they'll pass on that cost to the end consumer. And so what you'd find is that the end consumer will have to pay more money, probably not have increased in salary, but end up paying more money, which will affect key economic indicators like retail sales, which will impact CPI. And what we might find is that inflation's going up, and so the central banks will have to step in and start kind of tightening monetary policy, and in some way, shape, or form, that will have a severe impact on the economy, which will then result in currency movements to happen. Natural disasters is also key. So, for example, what was it, Cyclone Katrina in the US? That requires massive outlay. to the tune of billions of dollars that need to cover the cost of repair of all the damage. Insurance companies will have to fork out huge amounts of money. So that all has an impact on the economy. And then weather. What we found in the first quarter of this year was, say, in the UK, where severe cold weather did have impact on construction, and also as a result of that, people not going out to buy goods. Reduced construction in the commercial and housing sector meant durable good sales weren't happening, retail sales declined, and I think generally speaking, people were spending less money because they probably chose to stay indoors more. They weren't out and about. So that has a negative impact on the economy, which will then provide you a negative impact on the currency. And many of you guys would have traded that. I know in our previous videos, we discussed those setups and opportunities that were happening. Okay. Now, the next part is the economy. Again, the link to Ray Dalio's video is placed below this video in the info section. Please go have a watch of that after this video. It runs for about 30 minutes and it's going to give you a very definitive understanding of the economic machine. From my point of view, in short, the economy just represents the buying, selling, producing, and consuming activities of all the individuals, businesses, governments, and other organizations that kind of make up that social domain, right? So this involves utilizing raw materials, production, services that people and organizations and governments provide, all government-related expenditure, public works, and the like. Okay? Next, let's have a look at what the key economic indicators are. These ones specifically are what I'd like you guys to focus upon, and these would be on FX Street, Forex Factory, Investing.com, and whatever registered news site that you guys use. Basically, what all of these key indicators are showing us is the relative health of the economy. Remember, from the very start, we discussed that our key aim when it comes to fundamental analysis is to understand if the economy at that point in time is strong or weak, right? And then we're looking at the players, the likes of the central banks. Are they considering the economy to be strong or weak at that point in time? How do we determine if it is strong or weak? Well, we look at these key economic indicators. So these ones are the main ones that I want you to be paying attention to. We start off with PPI, so the Producer Price Index, and the next one CPI, Consumer Price Index. The Producer Price Index is what producers pay for their goods and services, right? So if the index is above expectations, that means to say that they've had to spend more money on their raw goods and materials. And as a result of that, what we're expecting or what we're thinking is that chances are that they've got significant orders coming through, and so they've bought significant amounts of raw materials, and then the production process begins, and then as a result of that, we're expecting that the consumers are going to be buying a lot more. We're going to get into correlation later on. I was about to jump into it, but I don't think now's the time. There's be too much information there. So basically, the correlation that I was about to mention was that PPI, if that's going up, we can expect that most likely CPI will go up as well. PPI gives us some idea of why the producers are paying more money for raw goods, or why they're buying more. This gives us an indication that possibly they're getting more orders coming through. Okay, so retailers buying more from them, and as a result of that, they're producing more. CPI, Consumer Price Index, this is what gives us a snapshot into inflation, meaning to say, are we paying more on a monthly basis for the same goods and services that we utilized previous month? Now, when we are, this gives the central bank some indication as to if inflation is kind of going out of control. Generally speaking, central banks like to kind of keep inflations at about 2% or thereabouts. Next, we have retail sales. This is extremely important for us because one, this gives us some degree of insight as to what CPI may be. If retail sales are positive, then we've got CPI figures that will be positive as well. PPI will be positive, and then as a result of that, GDP will be positive. Remember again, our overall focus is on whether the economy is strong or weak. So if PPI is up, that means that there are more orders, more money being paid for raw goods and services. So that generally only happens when the economy is strong. CPI, again, prices for goods and services will go up again when the economy is strong. Retail sales, if the economy is strong, people are employed, wage growth is okay. What we will find is that people will start to buy more. So retail sales will go up. If retail sales goes down or starting to go down, what that says to us is that generally people have stopped spending. Why people stop spending is usually because of other pressures. Humans overall, we're not the type of people that like to be sensible too often. So what we do is if we've got cash in hand, we'll buy. And at the same time, there's desires and wants and needs that we have. So everything from food to buying a new car or buying, furniture, clothes, that sort of stuff. And if these figures go up, again, generally gives us an indication the economy is starting to get stronger. Now, CPI, PPI, retail sales will give us some indication of GDP, the gross domestic product. Now, this is just a measure of all the goods and services that are produced over a certain period of time. Usually, it's quarterly, right? We've also got real GDP and nominal GDP, and we'll get into that in more detail in coming videos. Next one that's extremely important is employment data. So we've got the non-farm payrolls, the ADP, jobless claims, and the like. The idea here is to look at it this way. If we've got low unemployment, what that means is that the bulk of the population is gainfully employed, and most central banks will consider a unemployment number at about 4% or under as full employment. What that means to us is that when the jobless claims numbers come out and we're at full employment, that generally means that the economy is expanding, right? So the economy is getting stronger. There are more people employed. There's more people paying tax, and as a result of that, there's more money coming into the public purse. And also, with more people being employed, they're earning. They're going to go buy goods and services. Retail sales will go up. Probably even CPI will go up. And when they're buying goods and services, companies will start to innovate. They'll start to produce more. So PPI will go up. And when they're producing more goods and services because there is demand, GDP will go up as well. Okay, so all of these things are kind of interrelated and give us some idea of if the economy is strengthening or weakening it. And I'm hoping by now you guys are kind of seeing a pattern. I'm tying everything back to whether the economy is stronger or weaker, and as a result of that, the currency being stronger or weaker. Jobless claims, that gives us some indication as to how many new people for the first time are now claiming jobless insurance, or in each individual country, how many people are now, I forget what the word is, going in for the dole, I suppose. If we've got a significant number of new people coming in for jobless claims, that's more of like a leading indicator that can give us some insight into the economy slowing down, right? So again, when we're looking at the business cycle, I'll explain more in depth of certain points of where these economic indicators matter more. The next one, housing data. So when we're looking at, say, construction and building permits, if we're seeing the construction numbers higher than expected and even building permits higher than expected, again, what that's showing us is that more and more people are building commercial enterprise, building houses. That's going to lead to them buying more raw goods and materials. Those that are building houses, because of the increased building permits, They will go buy more retail in terms of furniture. They will go buy more durable goods, which is the next one on the list. And so as a result of that, there will be more transactions happening, more money flowing within the economy, more expansion of the economy. And again, as a result of that, the currencies will get stronger. So when it's getting stronger, what's happening is every time price comes back to a EMI, we look for structure, and then after a confirmation candle, we're in, right? So that is our confirmation, these economic indicators. Next one, PMI. So on a monthly basis, a survey is done by purchasing managers in factories and producing institutions. Basically, what we're trying to get to garner from them, or the information, is that the number of orders that they're coming through, the amount of raw materials that they're buying. This gives us some degree of insight into what the next month's figures may be in regards to, say, retail sales, CPI, PPI, for example, where if PMI is slowing down, that means that factories aren't producing as much, and so they're not buying as much. If PMI is above expectation, chances are that the orders that are coming through for them into their factories is higher than expected, and that generally happens when the economy is getting stronger. Okay, economy gets stronger, currency gets stronger. Economy gets weaker, currency gets weaker. The next one that's important for us, for those of you that trade oil, would be the OPEC meetings, right? Whenever OPEC meets, generally what happens is that they'll go three ways. One is that they'll say, we're going to produce more oil, we're going to reduce production, or we're going to maintain production. That's what we're looking out for. And usually, based off one of those three decisions, oil prices will move in a specific direction. So, when supply exceeds demand, prices will come down. When demand exceeds supply, prices goes up. Okay. Now there are other economic indicators. For the time being, I just want you guys to pay attention to this and do some further study in regards to how each one impacts on the overall economy, or what indication does each one give to us in regards to the overall economy. Okay. Now there's only one rule of thumb when it comes to these, and for those of you that really don't want to go in depth, it's basically, now hear me carefully, green is good, red, bad, right? What do I mean by that? You're going to have when you go to the news sites, you've got three columns there. So you'll have actual, forecast, and previous. Previous is what's happened when the last time that news was released. Forecast is generally what the consensus is in regards to what the expectation is, should be by the market. And then the actual is whatever the result is right now, right? So again, green is good, red bad. Green good for the economy, good for the currency. Red bad for the economy, bad for the currency. Right? So again, when actual is better than expected, the currency strengthens. When actual is less than expected, the currency weakens. Now, for all of us technical traders out there, this is where we look for recognizable structures where our EMAs are. And usually this is either there's a key news release happening during the Asian session, London Open, New York Open. This is why we say London Open, New York Open, simply because most of the news releases, or key news releases, the ones that we mentioned here, most of these will be released at the Open in London or the Open of New York. And that's where the market will most likely utilize that information to do stop hunts, to complete structures, and then move in the direction of the trade. Now, having said that, say for instance, overall you have an understanding of whether that particular economy is strong or weak, which gives you some degree of indication as to whether the currency is strong or weak. Say, for instance, news comes out that is either neutral or even just slightly above or below expectations. and then you see a massive movement occur within the market as a result of it. That's where this fourth point really matters, because that's where you can look at it and say, well, hold on a second, the market I'm expecting to be strong overall because the key economic indicators are showing me they are, but there is some indicator that's come through that's probably below par, and I'm seeing technical analysis wise that there is a structure being set where the market has kind of now starting to reverse back down towards an EMA, but overall this is an uptrend, right? This news caused the market to come down. What we're expecting is that wherever the EMA is or a Fibonacci point is, where the market will hit that dead, create some sort of a wick, create some structure, give you a confirmation candle, and then start moving in the direction of the trend again. So this is where your understanding of fundamentals will really help you to determine where the market should be going overall and how the market is kind of utilizing whatever the news release was at that point in time to then establish or complete structure. Okay? Now, here's a very important one. Remember when we're talking about technical analysis, and I keep saying that what you need to become familiar with over the course of your time in front of your charts is the different types of market conditions. Being able to recognize if a market is entering into a range, or being able to recognize if the market is starting to trend. Something like that can't be passed on. It's only something that you can achieve just by experience, but just sitting in front of the charts, looking at it over and over again. And for all of you, don't try and look for this in real time. Go over the charts, go back weeks and months to try and decipher. Study, what do those patterns look like when the market actually turned? What does the market look like when it's transitioning from one level to another? When it's transitioning from arranging a pattern, say a channel to a wedge to now an actual trend, that sort of stuff. Also, go back to look at where key fundamental releases happen. So if you can think back to when President Trump talked about tariffs, when President Xi replied to Trump in regards to, okay, we're going to cooperate. What happened to the various currencies that were connected with that? I know USD JPY started to skyrocket at that point in time. So go have a look at that and see what the behavior of those candlesticks were, that sort of stuff. Now, coming back to the news releases, do the markets move every single news release? And the answer is no. You could get your CPI, GDP news releases happening, and the market probably do absolutely nothing. Why? Well, the answer is the business cycle. So there is a false belief out there that presidents or prime ministers or governments have any real impact on the economies overall. Yes, they do through their budgets. Yes, they do through their internal policies. Central banks certainly have a huge impact on the business cycle and the economies overall. But generally speaking, what happens is that the economy will move through its business cycles, right? So, I'll give you an example. Right now, when we're looking at the US, okay, and you see President Trump in the news talking up how jobs are being created and the economy is stronger than ever, and you see a lot of people say, you know, Trump did this. It's because of Trump that the economy is so strong. In reality, it's not. I mean, he has very little to do with it. Essentially, his budget came out in November of last year, I believe, and I don't even think they've got a balanced budget yet. So I think it's just continuing resolutions that are happening. But the thing is that whatever he does in that regard, like, well, yes, the tax relief does have an impact on the economy and the like. But overall, what happens is that the markets follow the business cycle. Market goes through a phase of expansion. It will reach its peak, and then it will go into a contraction mode. It will go into repair mode. Then it will bottom out for a period of time before it starts to again recover. And from recovery, it'll go back into expansion mode, and then the whole cycle repeats itself, right? Yes, governments and governments in particular can have some degree of impact into the speed at which the market expands or contracts. Central banks certainly have impact on the market speeding up or slowing down. However, I want to make this very, very clear. Regardless of what governments do, the business cycle will generally continue to happen. You will have those periods of rise and fall. You will have those periods of consumer confidence increasing and decreasing, right? So, moving on, we generally expect the four phases of a business cycle. So, again, where expansion, peak, contraction, and the bottoming out, the trough, to happen over the courses of about 5 to 8 years. Right? Generally, that's what the norm is. You're going to see that whole process happen over the course of 5 to 8 years. In a very smooth running cycle, we're looking at probably about each phase being around 18 months or so. But what's happening right now, right? So, in addition to the 5 to 8 year cycle, we have about a 75-year cycle, right? The last one happened, or the last collapse happened in 2008, right? So, in that 75-year cycle, we were at the trough in about 2007, 2008, and probably 2009, right? And then starting on from late 2009 going on to 2010, we entered into the repair and expansion phase, right? So we've been in that phase for the last 10 years almost. Well, probably the last 9 years almost. That was called a massive deleveraging. The last time we had something like that to that tune was 75 years ago. So again, this bigger cycle that tends to happens every 75 years, and that last big one happened in 1929 prior to the 2008 one. Yes, we've had crashes since 1929, and in between that and 2008. Certainly 87, we remember that. 2000, we remember that. But overall, the bigger deleveraging that tends to happens over a 75-year period, right? Now, in 2008, we had that massive deleveraging, and what resulted was where central banks had to step in, and they started to do what was called quantitative easing, right? What that means is they just started printing a whole heap of money, because when the crash happens, when deleveraging happens, the major issue is that the liquidity pools dry up. Banks stop lending, usually because of their own crap, which is the derivatives market. Because of them going nuts with these products. Generally, when a crash occurs like that, the underlying asset that is kind of tied to these derivatives, that will fall. So that will mean that the value of the derivatives collapse and they're kind of worthless. And as a result of that, all of the money that the banks had tied up in these derivatives, they're actually effectively worth very little to nothing. And so as a result of that, they have very little free cash to be able to then fund public loans and the like. So this is where the central banks have to step in and say, well, in order to ensure that the economy is sustained and the currency is sustained, remember, actually, no, we haven't reached that point yet. So in order to ensure the stability of the economy and currency, what they need to do is start to provide liquidity. Okay, and we're going to get to how they do that shortly. But generally speaking, they will start to print money. They will start to flood the markets with money, liquidity. And then as a result of that, that's when the economy start to rise up again. The banks will start lending money again. Businesses will start to transact again, will start to produce and to buy and sell. Consumers will start to do exactly the same thing, and before you know it, the economy is back up. When a deleveraging happens, unlike the simple 5 to 8 year full phase process with the business cycle, in a deleveraging, this can kind of balloon out to over a decade. And so this is what we've been seeing since 2009 coming up to 2008. Me personally, I have started to see certain indications from leading indicators that yes, we're starting to reach the actual peak. If not being there already, I think we're at the top of the bell curve. We're going to last there probably for the duration of this year, maybe going into early next year, before we start going back into the contraction phase. So the market should start to fall. Now, various different um, people have their own opinions. Warren Buffett, he probably thinks that the economy is, well, the U.S. economy in particular has probably a couple of more years in her. Um, I personally, at this stage, I haven't done my overall analysis that gives me more of an accurate time frame, and again, that's more for a future video. However, I'm expecting that at least for the next year, going into early next year, we should be seeing clear signs that we're at the top of the business cycle curve and we're ready to kind of fall again, right? Now, we've seen what the ideal business cycle looks like, which is this, right? This is most likely, well, not most likely, this is what it really looks like, right? So you won't have the clear ups, browns, and downs. You will have, look at the period between 1990, that climb, and 2000. See the top of that curve? Well, it's not exactly a curve where the market comes down, goes back up, before there's a massive contraction phase that happened going into 2007, 8, 9, and then the absolute bottom that was hit down at 2010. So that's what the overall business cycle looks like. Um, right at the top of the curve is usually where we start paying attention to economic indicators that start giving us an indication that the economy is starting to slow down. So we'll start to see housing data decrease, auction rates will start to fall. Um, you'll see more houses on the market, but less people are buying, so house prices will start to fall. Retail sales will start to slow down. You'll get more unemployment data coming out, with so more people are being laid off. The PPI data, the PMI data will start to slowly decrease, which will give us an indication that the factories aren't buying and they're not producing as much as they used to. Um, and overall, that gives us an indication that yes, this economy now has reached its peak. It's about to kind of tip over and then starts to go into the contraction phase. Right at the bottom, usually what we find is that's where, again, the economic indicators really matter to us. It's there when we'll start to see retail sales starting to show promise that that those figures are going back up again. We're seeing a reduction in unemployment data. We see housing data go up, so the market's showing us that yes, people are starting to buy houses as a result of that. Durable goods sales will start to go up, and again, employment data where people are gainfully employed will start to increase as well. There'll be less jobless claims happening. And then GDP and inflation CPI numbers will start to increase, and also PPI and PMI numbers will start to increase to say that people are now buying more, and as a result of that, factories are producing more, and so the price of goods and services are going up, and then that whole process kind of just continues. So here's where, when we kind of look at certain economic indicators, we'll look at what the market's done previously. It gives us some indication as to where we probably sit within the business cycle. And utilizing that information, we can then keep an eye on the key indicators we need to pay attention to now. And once they start to show us that tip, that it's going from, say, green to red, or is going from red to green, that's when we can start to say, okay, if the market is in recovery phase and then goes into expansion phase, then we are expecting that this economy is going to get stronger, and so the currency will get stronger. And so, as traders, what we'll do is we will be looking to buy above the EMAs, and then again, remember structure, candlestick pattern, confirmation candle, market bouncing off the EMAs, confirmation candle, and we take an entry for that currency to go up. And the reverse is also true, that when the market is in decline phase, what we will be doing is every time the market comes to an EMA, gives a structure, when so price should be below the EMAs in this case, gives a structure and then starts to fall after a confirmation candle, we short the market. All right, so that's what the expectation is, and we're going to have, once the market starts to go into a decline phase, we will have plenty of opportunities to start shorting the markets, and the economic indicators that will be released, when they start to fall red, remember red bad, green good, when they start to form red, they're going to start showing us that these economies are starting to now weaken. And as a result of that weakening, currencies will fall. We go back to our technical analysis and follow the same criteria that I've been teaching in my previous videos. Okay? Now, when we're off, let's just go back here. When we're up at the top of that bell curve or the bottom of the curve, and we know that economic indicators will start to show us the change that's happening, who or what actually steps in to kind of be the saving grace? In this case, it's the central banks. These guys are the ones that set the monetary policy. These guys, essentially, their main role is to oversee the economy. Their aim, economic and currency stability, something we spoke about earlier. They want to keep check on inflation. So the overall aim here is for the price of goods and services not to kind of go absolutely nuts, where a loaf of bread costs $3.50 today, and then in a month's time it costs $6. So they will try and keep track of inflation. And the third and last one that's extremely important is for them to provide liquidity. Remember when I said when we're at the bottom of the bell curve, banks, due to their blunders with how they trade, they will lose liquidity within their balance sheets, and as a result of that, they will stop lending. Businesses will go into default, individuals will go into default, and so what the central banks need to do is step in and start funneling some money into the banks and governments and the like, so they have liquid cash to be able to then funnel back into businesses and individuals, so that then the economy can be restarted. So that's the role of the banks. Now, overall, most people kind of feel and believe that central banks are some kind of evil organization. Yeah, they've got significant power, and yes, they can really mess up economies overall by the wrong monetary policy being applied. However, the thing is that yes, they have huge monetary power, but they're limited in terms of what they can actually do. Yes, I'd be happier if we had more insight into the balance sheet of central banks, possibly them being audited every few years. However, there isn't that much that central banks can do in terms of their power, right? Let me just jump onto the next slide and then I'll come back and finish off this slide. So the tools that central banks generally have are the regulation of interest rates, the language they use, because all institutions, all traders out there will pay attention to what the central banks have to say in their statements. So when key members of central banks or the monetary policy committees, when they're out and about and they're giving speeches, we all want to listen to what they have to say. Because remember, fundamentals for us is trying to determine the strength or weakness of an economy, which will tell us the strength or weakness of that currency connected to that economy, right? When a central banker has something to say, we want to listen to them, because within their speech, within the language that they or their choice of words within that language, is going to give us some indication as to what their area of focus is. So if they're focused on interest rates going up, then we know that from the economic indicators that we look at, and also having a look at technical analysis, gives us some confidence that what we're seeing and feeling and thinking is on par with what the central bank is feeling, thinking, and seeing as well. And as a result of that, we then have greater confidence in taking the trades that we want to take, right? The third tool that they have is quantitative easing. Remember previously when I said that in order to provide liquidity, especially when the market's kind of contracting, it's hitting a trough, is where central banks will undertake a measure called quantitative easing. Simply put, they will print money. It could just be some numbers on a computer screen, or they will actually physically print some cash out. Now, we hear often that central banks are printing more money, but not too often will you be told that there isn't that much that they can do with that money. So effectively, all they're doing is they go out and utilizing that money, they'll either buy government bonds or corporate bonds, right? So institutional bonds. Now, government bonds are effectively how the central governments create money, right? So, when you hear, say, the US being $21 trillion in debt, what that generally means is that the US either creates government bonds or treasury bonds, and then that's put out into the open market, into the bond market. Now, institutions, individuals, other nations, um, corporate structures, uh, the 401k or superannuation funds, they'll all go out and they'll buy these government bonds. What that does is that gives the government liquidity, so money is coming in, and gives all of these bond buyers some degree of kind of safe um, assets to invest in. So in return, there'll be a 2-3% payout on the expiry of the bond. And that's where the central banks will pour money into as well. So they'll go out, they'll print all of this cash. Governments will create a whole heap of bonds, and central banks will come in and then just buy up all those bonds. So those bonds will go sit on the balance sheet of the central bank, and as a result of buying that, they provide liquidity to the governments, to banks, to private corporations as well. And so then governments go out and they start funding public works. They start spending a whole heap of money, and that money will then go out to buy goods and services from other companies who will need staff. And then as a result of kind of the orders that are coming through, they'll not only get staff, but also will buy other goods and services and raw materials. And then so the economy starts to kind of churn again. That's the whole process. When the central banks want to limit that and slow it down again, what they'll start to do is to probably start selling bonds back out into the market. Okay, let's just quickly go back here. Now, there isn't that much that you need to be familiar with when it comes to the central banks. Just be aware of the fact that there are probably about 6 main central banks that you need to become familiar with. The first one is the Federal Reserve, which is the one we call the US Fed. There are 12 reserve banks or Federal Reserve banks in the United States. The main part of the Federal Reserve that we need to pay attention to is, especially when you're looking at the the websites that release information, where it talks about FOMC, right? So basically, FOMC is the part of the central bank that's responsible for monetary policy. Okay, so that's what you'd be paying attention to every time you see an FOMC member speaking or an FOMC release that's set to happen. What I want you to do is pay attention to that. Go in, and have a read of what the news release might have been, have a read of what the speech might have been. That's, again, remember, the language is going to give you some degree of insight into what the central bank is looking at in terms of the economy and what their possible monetary policy may entail, right? In the UK, it's the Bank of England, that's the central bank, and what they have is called the MPC. You've got exactly the same thing in Japan, the Bank of Japan, and that's the MPC, just basically means Monetary Policy Committee. In Canada, you've got the Bank of Canada, and the part of the bank that's responsible for monetary policy is the Governing Council. In Australia, you've got the Reserve Bank of Australia, the RBA, and it's the board, or the Reserve Board, that will set monetary policy. And then we've got the European Central Bank, and they've got their Governing Council as well. So anytime you see in these registered sites FOMC, MPC, Governing Council, or the Reserve Board of the Reserve Bank of Australia, they're giving a speech or whatever it is, pay some attention to that. Generally, that's what helps us decipher if the economy is strengthening or weakening, or where the economy may go over the course of the medium to longer term. Okay. Now, we spoke about the aspect of the banks that establish monetary policy. What does it mean exactly? So, again, in line with the tools that we discussed, there's only a handful of things that the central bank can do. So one is that they regulate interest rates. That's the official cash rate. It also includes the rate that banks pay to each other when they're exchanging money or borrowing from each other. Also, we have the rate that the banks will pay to the Federal Reserve or the central bank when they are meeting reserve requirements. So, which is the second point, where the bank regulates reserve requirements that banks and commercial banks and other financial institutions must keep. The other function of monetary policy is open market operations. So remember earlier when we said central bank will print, create money, and then they'll utilize that money to go buy and sell bonds to regulate money supply in the economy. So that is what we refer to as open market operations. Okay. The other two terms that you will hear quite significantly when it comes to the wheeling and dealings of the central banks is dovish behavior or hawkish behavior. And quite often you will hear, well, the Federal Reserve is being dovish. And it may be where in their statements they're talking about either maintaining or decreasing rates, or they're kind of alluding to that fact. And so analysts will come out and say that central banks are probably being a little bit more dovish in their approach to the economy, and that's basically what they mean, decreasing or maintaining rates. If they're saying that they're being hawkish, then what they're saying is they're probably alluding to or confirming that they will increase rates. And effectively what that means is that it's increasing the cost of servicing debt. Now, how does that kind of, and I'm going to kind of take you off what we're discussing here for a second. When we're looking at increased rates, interest rates, right? Generally, yes, that means to us that the economy is getting stronger. That's a great sign. And so currencies will strengthen. But the outlook that I have for the next recession is not a good one, simply because from 2007, 2008, 2009, when we had the massive deleveraging, right? And so central banks started to print a whole heap of money. They went out and they started to pump cash into the markets via way of buying bonds, right? So corporate, institutional, government bonds. And all of these organizations, including central governments, started to spend heavily, right? So as a result of that, the economy started to strengthen and rise. And so that's what's given the economy the great strength. It's an artificial strength that exists right now. I'll use Australia as an example. So from 2007, 2008, 2009, after the collapse, when the rejuvenation period happened, the market started to expand at such a rapid rate to a point where, in particular with housing prices, right? So we went from, say, properties being about 600,000 or so to now um, selling within Sydney for about 1.2, 1.3 million, right? In that time, you probably saw very light increases in salaries for most people. And what you had was that with institutions, banks in particular, that they went back to their previous behavior of being very light in regards to lending money or requirements that you may need to fulfill in order to be able to borrow money. So what you find is that people that have their earning capabilities at about 150,000, maybe 200,000 max as a couple are able to borrow upwards of $1 million or so. And when they have that, what's happened is that the interest requirement, that's still there because interest rates are quite low, so they're able to service it, right? But over that period of time, their salaries haven't gone up significantly. So now, when the central banks kind of have a hawkish approach to the economy, simply because it's starting to heat up and they need to slow it down, and usually, when central banks, by the time they get to that point of trying to slow down the economy, again, it's usually we're at the top of the bell curve. We're kind of bending over, right? When that is actually happening, interest rates start to go up, which means the servicing cost to that debt goes up. Now, when you think about it this way, an average couple that's got, say, about 100, 150,000, 200,000 disposable, well, not disposable income, but that's their salary, that's their income, and they've got $1 million debt, and the present interest rate is, or cash rate is 1%, right? So their cost of servicing that debt is $10,000 a year, right? Um, Say, for instance, that cash rate goes up by 1%. All of a sudden, that cost of servicing that debt goes up to $20,000 a year, 100% of the previous servicing requirement. If then rates start going up to a point where you're hitting 4 or 5% or more, that same couple now has to fork out for 40, 50,000 in order to service that debt. Now, at 10 or 15,000, even 20,000, it's doable. But if they actually also have kids and they've got significant costs and cost of living goes up, then what they're going to find is that finding that extra 5 or 10,000 is really going to stretch them, right? Imagine getting to 30, 40, 50,000 extra that they'd have to fork out. That's really absolutely going to stretch them. So what you're going to find is that, one, if the companies that they're working for suffer any sort of stress, and as a result of that, they may start laying people off, these people will be in a tougher position. So what they're going to start to do is they're going to start dumping their properties in the market, because they will have to say, you know what, I'm going to sell my property. Whatever money comes back, I'm going to repay the banks, right? Now, in this situation, what we've got is another bubble. So when a whole heap of people can't service their debt anymore, and so they start dumping their properties into the market, what you will have is a environment where there is oversupply and not enough demand. Why? Because the various people that would have bought those properties, they're possibly risking losing their own jobs, and they probably have their significant pile of debt as well that they're not able to service. So you'll see property prices start to plummet again. And here in Australia, we've got recourse loans. So what that means is that if you borrow $1 million and you sell your property or the underlying asset for 800,000, you pay it back the bank. You still owe the bank 200 grand, right? So you will still have to pay that back in some way, shape, or form. So what we're looking at is a bigger problem now that exists than we had in 2007, 2008. And so right now, whatever is happening is kind of just like the delay before that problem actually happens. So how central banks approach this time around, we don't know. The other thing is that central governments, because of the deleveraging that happened previously, are now heavier into debt as well. So that means that they've got debt servicing requirements that they're going to have to meet as well. And this time around, there probably isn't a cash reserve sitting somewhere to fund, boosting retail sales and the like. So we'll probably have an extended period of recession that we're going to be heading into. Good news for traders is that chances are that we probably will, for those of you that are like me, that tend to short or appreciate shorting more than you do like going long, that we'll have hopefully more opportunities in that regard. Okay, next. Now, um, this is it for this video. I'm hoping that this gives you an overall idea of what fundamentals actually is. From here onwards, and for us as traders, our aim is always to determine the state of or the health of the economy, right? How do we do that? We do that by analyzing the registered news releases. So when the key indicators that I've mentioned there, when they're due to release, um, if it's green, it's good. If it's red, it's bad for us. That's all I want you to understand right now. In the following few videos, I'm going to go much deeper in depth. We're going to go much deeper into each one of those indicators so you've got a better idea of what they actually mean. And again, we'll look at the business cycle again to see which ones kind of really matter in which area of the business cycle, right? Next, I want you guys to pay attention to what the central banks are focusing upon. So again, if they're focusing on increasing interest rates, then we know economy is strong. They're confirming that for us, and so the currency should be trending up as well. If they're thinking about decreasing interest rates, then they can, or considering quantitative easing, that usually weakens the economy, and that also then will weaken currency, right? So those are the two major takeaways that you should have from studying and looking at fundamentals. Also pay attention to, again, the policies of central governments and how they impact on the overall economy, and then like the global trade environment and how that impacts on individual economies as well. But you probably have the general gist of how to apply fundamentals to your technical analysis, and then have winning successful trades. Now, from here onwards, I want you guys to follow the link in the section below this video and watch Ray Dalio's video. It's a 30-minute video. You're going to like it. He does really well with it. Following videos, I'm going to explain more of the economic indicators more in depth. We're going to look at currency pairs as well a little bit more in depth. So we're going to break down the US dollar, the yen, the Swiss franc, the Aussie dollar, the CAD, and pound and euro as well. So give you more of an explanation as to what the relative strength and weaknesses are within those currencies, and which ones will react to what sort of news, I suppose. Next, we're going to kind of discuss leading economic indicators. So there is a list of indicators that can give us a clear indication as to the rumblings within the economy that can tell us when the market is kind of tipping at the top of the bell curve or tipping back going upwards at the bottom of the bell curve, right? So that can help. We will also go much deeper into discussing correlation between the economic indicators. So remember when I was talking about earlier that if we were to look at, say, PMI, PPI, that will give us, or even retail sales, will give us some degree of indication as to what the CPI would be, which will also give us some degree of indication of what GDP will do, right? So all of these indicators are correlated with each other, and so if we can kind of look or understand about pairing them up, when one gets released today and the next one gets released 2 days later or next week, you kind of expect, based off what this indicator has done, be able to predict what the next one's going to do, right? And then going off just reading currency articles where analysts are talking about such and such was good, and so we're expecting this to be good as well. Well, that's your further confirmation. So if you then go to your charts and you're seeing structure that corroborates that, then you kind of know how to trade, right? In line with that expected trend. Okay. And the last one I'm going to do is sources of information. There's a number of websites that you can go to, but for the time being, just for now until I create that video, I'm just going to like Bloomberg.com, look at some of the currencies articles, investing.com, Forex Factory, and them in the news section. There's going to be articles there that will kind of give you this information. Okay, so I don't know how long I've been talking for, but that's it for this video. I hope this makes a lot more sense to you guys now. Please, if you've got any questions in regards to this video, please put it in the comment section below this video, so I'll have a look at that, and then according to that, I will tailor the next few videos that come out in relation to fundamentals. All right, guys, all the best.